Let's dive a little bit deeper. So I want to go into some tangible things that founders can do to improve their exit, both in terms of the deal structure and the valuation that they achieve. But why don't we start off just do like a bit of an overview about how exits are typically structured? Like, is it in cash? Is it in stock? What kind of stock do they get? What does that look like normally, and what are some of the gotchas or the hidden catches that maybe some first-time founders fall into?
Yeah, so there are typical. I even did a post about it today, just an hour ago, about the typical deal structures that are involved in SaaS M&A. One is, of course, cash. Cash is king. Second one is a seller note. So that means if a buyer doesn't have the liquidity to buy the full purchase price, it allows a buyer to have more room in terms of valuation. So as a seller, you basically give a loan to the buyer. That means you just get a part of the purchase price later after a year or two, and it carries an interest. So for example, you sell for 4 million, you get 2 million upfront in cash, and 2 million is seller financing or seller notes, which matures with like a 5, 6, 7, 8% interest rate. And so you get this 2 million plus interest after 2 years. It often happens in smaller transactions because buyers may not have the necessary liquidity and could finance a deal from the revenue or ultimately profits the acquired businesses generates over time. Then we have earnouts. This is purely performance based on operational or financial goals. So it could be growth milestones, revenue milestones, profit milestones, or a combination of them. But also could be, for example, handover projects an acquirer wants you to complete. So documentation of code base or integration projects. And so the last one is stock swap. So from the story I told earlier, that means you're trading your equity for the equity of the acquirer. That often happens with VC-backed companies. So they raised a new round, they got a markup to their valuation, and they're going on a shopping spree to acquire similar businesses, complementary businesses, and use their high valuation to play like an arbitrage game. So they try to pick up business for cheap, and you get stock in the acquirer. As mentioned earlier, there's a risk because if the business is not doing well, the stock will basically be worthless. So you need to be sure that you can get an upside and that you believe in the model or believe in the company that's acquiring you, that they succeed, and you ultimately get more than just taking cash up front. So these are the 4 most common ones. We don't do stock swaps at SaaS Group. We had some founders reinvesting some of the proceeds, but we don't offer it in our offers. But we usually use a combination of cash, earnouts, and seller notes. And what founders need to know is if you're optimizing for cash, the valuation will be slightly lower because the risk for the buyer is higher because the risk transfers to the buyer right at closing. And if you have an earnout, there's still a shared risk, so they may be able to go higher, and also with the seller note. So depending on what you're opting for, there's more risk for you involved, but ultimately also more upside, and you need to decide yourself what you're optimizing for.
But it's not a question of just cash or just seller note. Like, there is a combination of those things in any deal, right?
Yes. So as a founder, I would probably never accept 100% seller financing with seller notes, basically handing over the business for free and hoping that you will get something if the business does well with the new owner. That's not something what I would do. I would also not accept a super high proportion of seller financing in general. Like 30% plus is at least a yellow flag, maybe even an orange one. Earnout, again, you have to be sure that you can drive the business going forward, and that you can hit those milestones. You agree with the buyer to really get an upside, because sometimes you also see earnouts structured in a very bad way, where the founder only gets something if they triple the growth rate, or all of a sudden like double the business while historical growth was more moderate. So you really need to make sure that you agree on those milestones, that you think they are achievable, and that they are aligned with your exit outcome actually. And we, for example, we usually take 70-80% cash, and then maybe 10% seller financing, 20% seller financing plus earnout on top.
That makes a lot of sense. I have a friend, like serial entrepreneur. He's 3 or 4 exits by now, I think. But it's for his most recent one, he got absolutely shafted because it was mostly in stock. And it was a publicly listed company, so he knew the share price and everything like that. But even though his business individually was doing really well, smashing all their goals within the acquirers, the much larger acquirers business, the overall business didn't do so well, and their stock price fell through the floor. So he said, that's like 3 years of work down the drain. Because his shares were effectively worthless at the end of it. I agree with you that cash is king. Some seller finance, some other stuff in there probably makes a bit of sense as well. But I personally, after you told me that story, I'm a little bit cautious on taking too much stock.
I think you can also find a lot of stories where it went super well and they ultimately got much more because the stock was skyrocketing or they had a big strategic exit. So you basically find stories on both sides, but you need to know that there's a risk involved, and it can go both ways, and
absolutely
you may upend with nothing.
So let's do a bit of a deep dive into some of the concrete things that founders can do to increase the valuation or get better terms for their exits. Like what you talked about getting a churn rate under 5% as being one of those things that is going to make their business more attractive to an acquirer, but also probably going to get them a better multiple as well. What else can a founder do?
I would say, more generally speaking, bring your business in order. So especially in small SaaS companies, you don't have proper metrics tracking sometimes, weird financials where we need to ask multiple questions to get a sense of how the business is doing because they have weird line items in their P&L, and it's just like confusing, and you need to be aware that you're always creating a bias. So if I talk to a founder and they say, yeah, we are keen to exit, blah, 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 let's sign an NDA, move forward, and it takes them 4 weeks to provide me with a P&L, that's already a bad sign. And we know we need to take a really close look at how this business is doing. And that's why I would say just come prepared, have your numbers in order, have your stuff in order, know what you need to prepare. I mean, you can just Google like data room for acquisitions, data room for investment, and you can find multiple sources, what you need to prepare, like corporate documents, cap table, etc., vendor agreements, third-party solutions you're using, your employment agreements, organizational structure and everything. So there's a lot of stuff you need to provide. Secondly, I would say you need to be aware that you should show full transparency of everything. So it doesn't help a process if you're trying to hide something or if a buyer thinks you're trying to hide something. So I also have a bad feeling if I say, hey, I need raw invoicing data, I need your P&Ls, I need this, and they say, okay, maybe it helps if I first send you just screenshots from our metrics tracking dashboard. And then I say like, this is not how we can work together. What else? I would say making yourself obsolete as a founder, easier said than done. Even more so because now everyone is saying you need to have a personal brand these days, and a lot of founders keep posting on LinkedIn and being super present. Yeah, it may have a positive impact in the short term on your business, but if it comes to exiting your business, this may be seen as a risk by acquirers. So make yourself obsolete. Ideally, you even have potential successors in place, or potential successors, someone from the management you could potentially promote, or your co-founder who will stick around while the other one leaves, stuff like that. So the easier a potential transition is for an acquirer, the better it is for your ultimate outcome. And we could probably talk hours about improving KPIs. So increase your growth rate, decrease your costs. Great, also easier said than done. But there's also a lot of qualitative factors and a lot of things you can mitigate by just doing the basic stuff, like creating a basic data room, uploading all the stuff you need anyway. I even heard from a founder who was looking to exit in the next 1 or 2 years, and they had a data room prepared and they just updated the stuff every month. So updated P&L, updated metrics dashboard. I don't know if you need to be so sophisticated, but at least have the basic stuff when a buyer asks for it. And yeah, good KPIs are one thing, but a lot of soft factors are equally important.
Do you look at the from a marketing perspective? Do you look at the traffic sources that they've got? Like, if you've got a business that is completely dependent on Google Ads versus a business that has multiple sources of traffic for the website, does that scream that this business might be a bit high risk if they're completely dependent on one channel, or is it a pretty minor factor?
Yeah, it's definitely something we would factor in as a risk if traffic comes from one channel. I mean, some businesses just have, for example, a platform dependency, talking about Shopify apps or Salesforce apps or whatnot. So this is a risk we would factor in. Another big discount factor is customer concentration. So if 50% of your revenue comes from top 3 of your clients, for example, you can't expect to get a multiple on the total revenue, but probably need to accept the decent discount. And same applies to traffic sources. So I saw companies that were only growing by pumping hundreds of thousands of dollars every month into Google Ads. Probably not that sustainable. So if you probably reduce the ad spend, growth will tank and maybe even become negative depending on how your churn rates are. So ideally, especially for our focus on PLG companies that mainly thrive by getting inbound traffic, it's good if they are getting a decent amount of organic traffic versus paid.
Absolutely. And even then, who knows what's going on with Google at the moment? Didn't HubSpot, I think they lost more than half of their traffic recently with all the AI updates and everything. So even if HubSpot's not immune from that, you as a much smaller SaaS founder, you want to diversify your traffic sources, I think, as much as possible. Is there anything that leaps out at you as being different about selling a SaaS business versus e-commerce or a bricks and mortar business, or like another different category of business? Is it because the revenue's earned over time versus upfront? Like, what do you need to know about selling a SaaS business specifically that might make it a little bit different from another kind of business?
I would say, speaking from my own experience, the process is much smoother than if you would sell a service business or a brick and mortar business, because then you would probably need to accept an on-site DD and people like going into your rooms and picking out stuff to review. So that's why we can have those short processes, because you basically have everything digitally. You give us access to your ad accounts, to your billing system, to your tools. We can look at everything. Usually you have all the stuff digital, so no need to send us faxes or anything. You just take a screenshot or whatnot and send us the stuff. So I think it's much easier and ultimately also easier for you to prepare. I think a common misconception is that low growth companies or no growth companies tend to be valued using profit multiples. That's what I keep educating founders on over and over again, because they think, hey, my business is growing 5%. I'm looking to get 5x ARR. That's not how it works, because if you look at brick and mortar businesses and every other segment out there, businesses trade on EBITDA or profit multiples. I think sometimes maybe revenue multiples, but usually you look at profit multiples. And ultimately that's also what applies to SaaS businesses, but because of that special model of the SaaS customer acquisition, that you have a larger upfront cost to acquire a customer and then you earn it back over time and get into a positive ROI zone, it was more relevant to compare companies using ARR revenue multiples, but for low growth companies you don't have those strong dynamics, so you can clearly see based on historical current numbers how it will be going forward, and that's why it's very important for buyers actually to see positive cash flow. So if you have low growth and you're running at break even, that's not how you get the best valuation. And also from my experience, most businesses have cost saving potentials, sometimes more, sometimes less, but there are always line items that can be removed, be it like the expensive office in the city center, be it like, I don't know, expensive company cars, whatnot. So there's often something, expensive conferences you're going to, I don't know. I also had one case where the founder was flying back from US to Europe because his wife and the kids were based in Europe, but the business was based in the US. And so they had and he was flying business class all the time. And so basically travel costs of like 150K just for that purpose. So as I said, sometimes more, sometimes less, but you see weird things when you look at income statements of companies. And again, talking about the rule of 40, buyers these days look at your efficiency and they want to see that your business can grow, but at the same time also turn a profit. And ideally you can show both. If you can only show growth, then they might question your ability to generate cash flow. If you're a cash cow business with high margins, no growth, they will question your ability to grow.
Absolutely. But I think that comes back to what you were talking about before, when in terms of getting your house in order, because I've seen lots of cases where founders will run a bunch of personal expenses through the business, like the travel expenses that you were talking about before, or they'll pay themselves like a tiny little salary or no salary at all to make their business look like it's far more profitable than it actually is. But would you agree that what you should be doing, maybe you do that initially to save on taxes or whatever, but when you're getting into I'm going to sell my business mode, you want to run it like a proper business, take all your personal expenses out of the company, pay yourself a market salary, because if they're going to get rid of you as the CEO and replace you, they're going to need to pay someone, and that person is going to need to demand market rate salary. And so, for a year or two before you sell your business, you probably, you want your profit to be as high as possible, and you're probably paying tax on that profit, which sucks, but at least you've cleaned up your P&L quite a bit by that point. Is that something you'd encourage founders to do?
Yeah, so you do not necessarily get rid of all those things. I mean, it's quite common, especially for smaller bootstrap companies, that founders are running some personal stuff through their business, which is totally fine. That's not a red flag, but we would make our own calculation how the business would look like. So we usually, if you send us your financials, if you send us your KPI, we would create a pro forma P&L, how it would look like as part of SaaS Group. So that's also something founders need to know. It's not, hey, I sent them my business numbers and it looks super great because I have, let's say, 2 million EBITDA on a 4 million business, but there's maybe capitalized R&D expenses and I'm not paying myself a salary. My co-founder also doesn't get one. So it's ultimately we would look at the business and say, okay, founders are not paying themselves a salary, so we need to consider that going forward, and all that stuff. So we would use the stuff you're telling us plus the numbers we're getting to build our own P&L to see how it really looks like. And especially in the small SaaS company space, we use SDE. When we talk about profit multiples, it's more about an SDE multiple, or maybe sometimes also EBITDA multiple, where we an SDE means we exclude founder salaries, because as you just said, sometimes founders are paying themselves $500,000 and sometimes they haven't been paying themselves a salary for the last 5 years, which just gives the wrong picture on how the company operates. And we would corrected in our calculation.
And what are your thoughts on SaaS businesses that have other revenue streams? Like I've seen that, particularly with bootstrapped businesses a little bit more lately. They talk about software with a service, or they have an info product as well, or they've got payment processing, or they've got, they've got something beyond just the software subscription revenue. Is that something, like, how do you separate those revenue streams when you're deciding on multiples to offer? Do you lump them all in together? How do you deal with businesses that have several revenue streams and one of them is the software subscription?
Yeah, so we would always slice and dice all the numbers to see how different features are performing, or different pricing packages. We look at monthly cohorts. So generally speaking, we want to know everything, and we will really create tens or even hundreds of beautiful charts to look at all the dynamics behind it. And it's definitely legit to have multiple revenue streams. If it's too much service revenue, then it's probably not for us, and maybe a few other SaaS acquirers. So I think for us, the threshold is at 10-20%. If it's more than 20%, probably not for us. That doesn't mean your business is not sellable. We are just not the right fit, but there might be others that don't care, or for them it's even important that you have a service component. What's important for us is also that the service component in itself is profitable. So not loss making and basically making your whole business look worse, but ultimately better. And also what I mentioned earlier with the pricing, so we see AI features maybe priced more based on outcome versus maybe usage or traditional seat-based pricing. I think it's definitely good to be diverse and not just rely on one single thing, but it should be profitable, should be sustainable, and we want to see that the metrics of that revenue stream are also looking good ultimately. And this could be affiliate revenue, partner sales, service revenue component, whatever, but we want to see that it's sustainable. So to give you a simple example, it's actually an experiment which we are currently running. There's one business in our MarTech tech stack, and a lot of customers are trying to sign up and then figure out it's not the right product for them, but we actually know what the right product for them is, and so we can forward them to the right vendor and basically earn affiliate revenue through it. So give you a simple example. They sign up for our solution, it's not the right for them, we send them to, let's say, SEMrush or Ahrefs or whatever the dominant player is that's relevant for them through an affiliate link. Then we generate sales for SEMrush and earn an affiliate commission. I don't know how it will pan out and if it ever will become a relevant revenue stream, but I'm just saying there are multiple ways to unlock new revenue levers.
That's really clever. I've seen a few people using a similar tactic to that. You're effectively, you're monetizing, well, not churn, I guess, but people that were never going to sign up and become customers in the first place, but you've captured the lead. You might as well monetize it if you can. The affiliate revenue is really interesting because someone pointed this out. They gave a workshop for our community a while back, and they said that nobody uses a SaaS tool in a vacuum. Like, if you buy a service, you're sort of buying someone that will solve your problem. But if you're buying a SaaS tool, well, that exists in a workflow. There are other people involved in that. There are other tools involved in that. There's something that you do beforehand. There's something that you do afterwards. And so it makes sense to kind of map out what that whole space looks like. And maybe it makes sense to incorporate some other tools in there. We had a guy who had a SaaS product for finding backlink opportunities. It was an SEO tool. And what really accelerated his business was when he partnered up with a company that actually built the backlinks. So before he would show you, hey, you should get a backlink here and here and here, but then he replaced it with a button that says you should get a backlink here. Click here and we'll connect you with someone to actually get the backlink placed for you. And that, taking an affiliate cut of that's what really, that improved his LTV, which meant that he could spend more money on ads to acquire more customers, which boosted his growth rate. Like that unlocked so much growth for him, that little hack like that. Dirk, are there any other tools or books or resources that you would recommend to SaaS founders that are maybe thinking about selling their business?
It's a good question. I mean, one answer would be follow my content on LinkedIn because I try to educate founders a lot. I mean, I haven't touched upon my whole CV, but I also came into SaaS. I did know nothing about SaaS and M&A, and I had to learn everything from scratch. And so I try to also now share my own learnings, but also stuff I prepared to educate founders on how to exit, what to expect, how to value companies, and so on. And you can find a lot of stuff. I mean, I'm always kind of biased because we are an acquirer and we have a personal interest to generate deal flow, right? But you can also talk to brokers. They often give you information about how they would see your business valuation-wise. They sometimes also have good blog posts, how to value your business, what to expect. There are a lot of benchmarks out there. So if you want to compare your business to others and how you could be valued, this is something where you could go like Chartmogul and High Alpha and how they're all called, benchmark it. I think I even shared a list once with all the benchmarking reports I was reading. So there's a lot of stuff out there. There's no particular book I can recommend, but it helps to do some research and read some stuff. But on the other hand, I also recommend just focusing on your business unless you're really actively selling to not get distracted. It's just interesting also because I'm very active on LinkedIn how it became super noisy and everyone shares like their number one framework for tremendous growth and stuff. I would say sometimes it just helps to stay away from this noise and just focus on your core business and listen to what your customers are telling you. Actually, we acquired some businesses where the founders were not active anywhere, like no LinkedIn profile, no Crunchbase profile, not talking to any founders, and still were able to build successful businesses. So it sometimes just helps to not get distracted and just focus on growing your company and making your customers happy instead of hanging around at conferences, talking to a lot of others and hearing what works for them, but maybe not for you.
I think there's a lot of wisdom in that advice because it's very easy to get distracted.
Sorry, I'm saying this because you run a community, right? So.
Yeah, all the other communities, yeah, but our one's a little bit different. You should totally take the advice there. Dirk, it's been a pleasure, mate. If anyone wants to get in touch with you or they're interested in maybe having a conversation with SaaS Group about selling their business, what's the best way to get in touch?
Yeah, so my LinkedIn inbox is actually pretty messy, so ideally you just drop me an email. I'm an email person, dirk@saas.group. Of course, you can also try via LinkedIn, but may take a bit longer for me to respond. Would appreciate if maybe some people follow my LinkedIn content and engage. And I also run a newsletter. I took a creative pause, but I'm trying to restart again. Have some articles in the pipe under saas.wtf. So yeah, just let me know. I'm actually always happy to help, and talking to me doesn't mean I will force you into a process, and I will try to catch up every couple of weeks with you. So I'm happy to just help out, give you some guidance on how to prepare, on what your business could be worth, on how to approach buyers, etc. So yeah, feel free to just ping me.
Dirk, thank you very much, mate. It's been a pleasure.
Yeah, thanks for having me. Really enjoyed the session. It was fun.